Okay, wow. Let's just dive right into this because the KOSPI just pulled off an absolutely jaw-dropping reversal. We're talking a massive 5.89% surge in a single trading session, but what actually triggered this historic rebound? Let's figure it out. Welcome to today's Rapid Market Explainer. We've got a lot of ground to cover, so we're going to move fast. We're executing a high-energy deep dive into the real catalysts behind this massive surge. We'll be breaking down the macroeconomic dominoes, some absolutely wild corporate mega moves, and maybe most importantly, the hidden signals that the smart money is quietly leaving behind. So buckle up. The data today is just fascinating. Right, so here is our starting point. The KOSPI Composite Index actually opened lower, completely tracking those earlier global plunges tied to U.S. Treasury yield spikes. I mean, it was looking grim. But then, it fiercely reversed course, closing up an aggressive 5.89% at exactly 6,852.58. Think about that for a second. It's a stunning pivot from a market that had literally just triggered a sell-side sidecar, a market circuit breaker, only hours earlier. And if you look at the market heat map, it's just a sea of green. But, well, actually, don't let all that green fool you into thinking everyone got a piece of the pie. This massive index gain was heavily, I mean almost exclusively, concentrated in large-cap semiconductor stocks. To put it in perspective, while those large caps surged over 6.4%, mid and small caps, they barely moved the needle, crawling up less than 1%. So, to understand why the large caps suddenly caught fire, we've got to look at the macro domino that tipped this whole thing over. $29 billion. Yep, the U.S. Treasury made a huge announcement. They're going to more than double their buybacks for long-term bonds, specifically those 10 to 20 and 20 to 30-year maturities starting September 9th. Make no mistake, this represents a massive, undeniable liquidity injection straight into the global financial system. And here is exactly how those dominoes fall. Step 1. That expanded Treasury buyback mechanically increases the demand for bonds. Okay, so step 2. That extra demand drives U.S. long-term yields down. Step 3. Those falling yields automatically lower the equity discount rate. And finally, step 4. A lower discount rate inherently creates a much higher present value for future corporate cash flows. Basically, this chain reaction creates incredibly fertile ground for stock gains, especially for those capital-heavy tech firms. But listen, macro conditions, they really only set the stage. To truly understand this surge, we have to look at the mega catalysts happening right inside the semiconductor sector. Let's zoom in on the two heavyweight giants that basically seized this liquidity and forcibly dragged the entire Korean market higher. We're talking about the dueling titans here, Samsung Electronics and SK Hynix. Now, at the start of the day, both of these giants were actually facing intense selling pressure. Investors were frankly highly spooked by rising AI data center costs and these lingering fears of slowing demand for HBM and DRAM chips. But then, both stocks rapidly reversed course. And it wasn't just because of those falling treasury yields we just talked about, it was because of some totally unprecedented corporate actions that completely shifted investor psychology. Check this out. On one side, we've got SK Hynix coming out with an aggressive, completely confirmed plan to buy back and cancel roughly 40 trillion Korean won worth of shares. I mean, that completely obliterated the market's expectation, which was sitting at just 20 to 30 trillion. And then, on the other side, we have this explosive industry rumor surrounding Samsung Electronics. Whispers of a potential special cash dividend and shareholder return package worth a staggering 100 trillion Korean won. Just the prospect of that much capital being returned to shareholders sent valuations absolutely skyrocketing. But hey, before we get completely swept up in all this bullish euphoria, we need to pump the brakes for a second and look at the hidden reality of the capital flows. 1.72 trillion Korean won. That is the massive amount of KOSPI cash equities bought by foreign investors in just a single day. At first glance, sure, that looks like a tremendous vote of confidence in the Korean market. But as always in financial analysis, the devil is really in the details. Let's stack this data up to reveal a pretty striking discrepancy, what we like to call the smart money's hidden signals. Yes, foreign investors bought 1.72 trillion in cash equities. But look really closely at the second point here. An overwhelming 96% of that buying was concentrated solely in just those two stocks, Samsung and SK Hynix. And while they were doing that, they simultaneously net sold 1.54 trillion won in KOSPI 200 futures and dumped another 128 billion won of KOSTAT cash equities. Think about what that means. They're aggressively buying two tech stocks while simultaneously aggressively shorting the broader market. Now, you might be sitting there thinking, oh, well, that's just standard index arbitrage. But actually, it's not. See, pure arbitrage requires a pretty wide price gap between the cash and futures markets to make a risk-free profit. But on this specific day, the futures basis was sitting at just plus 0.40 points, which is well below the theoretical plus 1.78. Because the incentive for profit there was mathematically limited, this wasn't arbitrage. This was a carefully calculated hedge position designed specifically to reduce their overall exposure to the index. Which brings us to our canary in the coal mine. Guys, this is a severe warning sign that we really need to pay attention to. Foreign investors are not buying the broad Korea is rising narrative. Instead, they're making a highly concentrated surgical bet on just two stocks driven by shareholder returns, all while actively hedging against the rest of the Korean economy. That is a deeply defensive posture, totally masked by a headline-grabbing rally. And honestly, that defensive posture makes total sense when you look at our second major warning sign. We are seeing rising oil prices driven by some pretty severe supply risks over at the Strait of Hormuz. This threatens to reignite persistent inflation pressures. And why does this matter so much to the stock market? Well, because if inflation stays sticky due to energy costs, it completely caps the Bank of Korea's room to cut interest rates. And that puts a hard ceiling on broader economic growth. The data is already confirming this pressure, too. Oil prices have now risen for 5 consecutive trading sessions. The bond market is reacting instantly to this inflationary threat, with the Korean 3-year government bond yield actually ticking up by 1.2 basis points. So, while long-term U.S. yields dropped, the local short-term pressures right here in Korea are actually rising. So, we are left with a really critical question to close out today's explainer. Is the broader market dangerously ignoring this 5-day rise in oil prices and the highly hedged defensive bets of foreign capital? That 5.89% KOSP rebound was mathematically spectacular, sure, but the underlying flow of funds suggests extreme caution going forward. If you would like to receive news on the closing of Asian stock markets before the New York stock market opens, please subscribe.